Hey guys, how's it going? Welcome to Pounds Invested, your place to learn about economics, finance and investing. I'm your host, Stephen Georgiev. Before we get into today's video, I really want to thank the 400 or so of you who watched my video on the impact that the coronavirus might have on the economy. I also really want to thank the 20 of you who have subscribed to my channel already. It really is motivating me to keep going. Here's a link to my previous video just in case you missed it. Check it out, it's good stuff. Now, on to today's topic of interest rates. How do they work? Well, the Bank of England sets something called the base rate on a monthly basis. The base rate influences the rate that we earn on our savings at banks. It also influences the rate that we pay on our mortgages. During a period of economic difficulty, the Bank of England may well set the base rate low in order to encourage borrowing. This works because retail banks take their cue from the Bank of England when it comes to setting mortgage rates. So if you imagine, when the Bank of England sets the base rate low, then mortgage rates at commercial banks are also going to be low, and so it's cheaper to take on more debt, and so you're more likely to then go and buy a house or a car or expand your business or whatever you wanted to do. As you can see from this graph right here, the Bank of England has been setting base rates for a very long time, over 300 years in fact, since 1694. Because the Bank of England set the base rate at a then record low of 0.5% during the economic crisis of 2008 to 2010, and then didn't move it back up again, what that has meant is that now, as we enter the economic hardship caused by coronavirus, the Bank of England is to some extent out of options when it comes to stimulating the economy because the base rate is already low, mortgages are already as cheap as they're going to be, and yet people aren't necessarily going to want to borrow. Why? Well, like we said last time, around about a quarter of the workforce is currently being supported by the government through the furlough scheme, and so security around their jobs is quite frail, and so they're not going to be particularly confident when it comes to borrowing, and so no matter how cheap the mortgages are, people aren't necessarily going to want to borrow because they're scared about their own future prospects. Now, the Bank of England's number one job is price stability. What does that look like? Well, it looks like a rate of inflation of around about 2% or so. As you can see from this graph right here, the rate of inflation currently is around about 0.8% and has been low for quite a while now. That's a good thing and a bad thing. It's certainly a good thing for consumers because the cost of living doesn't increase much each year, and so you know from day to day what the price of bread and milk's going to be in the supermarkets. More or less. For businesses, on the other hand, the rate of inflation is important because they use it in order to determine the annual increase in wage rates. So if you have a low rate of inflation, businesses are going to be less likely to hand out bumper pay packets each year because they know that the cost of living hasn't increased so much, and so why would they pay their employees more than they necessarily have to? One downside of a low inflation rate is that perhaps consumers are going to put off making big purchases. Why? Well, because the cost of living isn't increasing at a particularly high rate, then unless something is urgent, you may as well buy it later when you feel more secure about your own financial situation. That in turn leads to a drop in activity in the economy, which is of course worrying for both the Bank of England and the Treasury. But back to the base rate. How low could it really go? Well, let's have a look at this graph over here, which compares the relative rates in various countries. As you can see, countries like Japan and Sweden and Switzerland have experimented with negative interest rates, and with varying degrees of success. So, let's see what the impact is on you. If, like many people, you have savings in a bank account, you'll have noticed over the past 4 or 5 years that the return on that investment is actually pretty poor. So, on average, research from the Bank of England suggests that easy access savings accounts pay a paltry 0.45% interest annually. And I think you'll agree, a rate of less than 0.5% isn't really worth getting out of bed for. Now, is it the same if you were willing to lock your money away for a year or longer? Well, it is, kinda, yeah. The average rate for a 1-year fixed deposit is again around about 1%. Now, if you're investing 1% annually, you can go and calculate how long it'll take for you to double your money. William the Conqueror is probably still waiting from 1066. So we've seen that savers are adversely impacted by low or perhaps negative interest rates. But are we actually likely to see negative interest rates in the UK? I'm not convinced, simply because in the UK retail banking market, there's so much competition that all it would take is one bank to break ranks and offer a paltry positive 0.001% interest in order for it to have a queue of customers outside the doors. After all, a rate of positive 0.01% is far better than a rate of negative 0.01%, because if that's the alternative, at least you're getting something back on your money. Now let's look at borrowers. Well, if you had a mortgage over the past 10 or 12 years, you'll have noticed that the amount that you're paying back in interest on your mortgage is very, very small. Indeed, as we can see from this headline over here, of one bank in Denmark fairly recently even offered a negative interest rate mortgage. That in theory would have meant that any borrower who took out that particular product would have been paid to keep their mortgage. But is that really likely to have been what happened? Again, I'm not convinced, because although the mortgage product had that headline-grabbing negative interest rate, I imagine that the bank would have made up for it by increasing the product fees on that mortgage in order to make up for the loss on the interest payment. So, how did low or perhaps negative interest rates impact banks? Well, very simply, a bank profits on the difference between the interest rate that it pays you as a saver and the interest rate it charges its borrowers. And ultimately, because interest rates have been on a downward spiral and have stayed low for a very long time, and may even go negative now, that difference between the two rates would be eliminated, and so the bank wouldn't make any profit. Additionally, banks face an adverse hit to their profits when it comes to existing mortgages. This is caused by a drop in investor confidence, like we covered briefly last time. So if you're less confident that you'll keep your job going forwards, one of the things that you might be considering cutting from your budget is your mortgage repayment. And so ultimately the bank will make a loss on that mortgage. If this happens at scale, banks face making a loss on thousands of mortgages at a time when their profits are already squeezed, because the difference between what they pay you on savings and what they charge you in interest payments on mortgages is already very, very small. So we can conclude, therefore, so far, that savers are negatively impacted, borrowers are positively impacted because they have less to pay out, and banks are ultimately negatively impacted because they find themselves not able to charge as much money for mortgages. One interesting quirk of the UK banking system is that we have these things called building societies. Now, are they impacted the same way as banks are? Interestingly enough, no. So what makes a building society unique is that where a bank can just turn to financial markets to borrow and meet its funding needs, a building society legally cannot. This is because building societies have to make up around about 50% of their operating cash from individual savers. So really, you could argue that building societies are going to be the worst hit because they don't have as many funding options as banks do. So, grim times for Nationwide perhaps, we'll see. In review, could you end up having to pay your bank to store your money in its vaults? I'm not convinced, just because of the amount of competitive pressure in the UK retail banking market. Okay guys, thank you for watching this video. I hope you found it useful. If you did, make sure to hit the like button. Make sure also to subscribe to my channel. And in our next video, I'll be looking at how on earth we're going to end up paying for all of the government bailouts and largesse that we've been treated to during the coronavirus crisis. Join me then.